let me start by saying welcome and thank you for joining all 271 of you so far on what will surely be one of the most riveting parts of your day, webinar on financial statements. And so I'm going to be taking a few minutes to kind of walk through. For those of you who don't know me, my name is Michael McComas. I'm the Executive Director with ACCSC. And I'll take a few minutes today to talk a little bit about both what our current and long-standing requirements have been, and then I want to touch on two additional areas that are somewhat new. And so this is going to kind of run a bit of a spectrum. Also, for those that are really experienced, I'm sorry that I'm going to start out with some really kind of basic information, but I do know that there are folks on this webinar as well that are brand new, that have not gone through this process before, maybe initial applicants, maybe submitting financial statements for the first time, might be an accountant or accounting staff that are trying to bring themselves up to speed. So I am going to start with some pretty basic information, and then I'm going to move into some of the other new developments that have transpired here in the last year or year and a half. So with regard to questions, you can put a question in the chat. There are ACCSC staff that are monitoring the chat. So Michelle Ragland and Alicia DiMartini and a few other folks are lurking and may or may not be able to answer questions that come through the chat function. And so we'll try and do that real time. And then you know, if you at the end of this webinar continue to have some questions or need to do a follow-up, or you're always welcome to reach out to staff. So I'm going to go ahead and just quickly share my screen here. I have a PowerPoint presentation, of course. Michelle, can you see that PowerPoint presentation? She's in the room here with me. So yes, I'm going to go through and hit some of the, again, just some of the basics. This is 101. It's a primer, so pretty basic stuff. But you can start with the instructions for the submission of and preparation of financial statements and related information. It's found on the ACCSC website under the Forms and Reports section. And this document really goes through and lays out specific information around what the requirements are for preparing and submitting those financial statements. So I'm just going to put us on hold for 1 second. Michelle, I just got a quick notice that my battery's running low. So if you have a thing, that would be great. Sorry. I thought I prepared for everything, but obviously not. So those instructions are going to go through and talk about how the Commission only accepts audited financial statements. We will not take a reviewed or compiled statement, at least for the fiscal year statements, and we'll require those also to be prepared by an independent CPA in accordance with generally accepted accounting principles or GAAP, which we probably all know about. Okay, so there are 4 necessary components to the financial statements. If you're a CPA or someone that works in accounting or took an accounting class, you probably know this. But one of those, of course, is the balance sheet. And this is the area that has the assets and the liabilities, both current and total. And within that is going to be cash and cash equivalents, any receivables. That would be things like the amount of money that you might have received in your contracts and the enrollment agreements that are due. You want to make sure that you've got within that and you're reporting for things along the lines of gross tuition. If you don't break out gross tuition on your balance sheet, then when you go through and calculate your sustaining fee at the end of the year, you're going to have to do that based upon total income. We only base the sustaining fee on gross tuition revenue. So anyway, in addition to having all your receivables booked, because again, this is the accrual basis of accounting, then you're going to also have a corresponding deferred income or unearned tuition line on your on the liability side that basically offsets and said if everybody dropped out as of that day, how much money would have to be returned or would be against those receivables would be counted as unearned tuition. The balance sheet is also going to have information about any notes receivables and any notes payable, long-term, short-term, and then also include equity or net assets. And again, that's going to give you both your current assets and current liabilities and your total assets and total liabilities. ACCSC doesn't use as a matter of benchmark or as a matter of tripwire a one-to-one current assets to current liabilities as a measure for financial soundness. However, having said that, it is a key indicator. Do you have as many or more assets than you do have liabilities? The next component is the income statement, and this is going to include all of your expenses, your income, any gains that you've made, losses, and basically is the reference that you can use for net profit or net loss over the period of that fiscal year. Statement of cash flows is the third element. It's going to summarize again the movement of cash or cash equivalents. Cash equivalent would be something like selling a stock or some other kind of thing that was otherwise liquidatable within wouldn't be a piece of property or something along those lines. So money that would come in and out of the company. And then lastly, section number 4 are notes. Financial statements have to include notes, and this would go in and talk about a variety of things, how things were calculated, what are the lease requirements and the lease liabilities, both as an asset and as a liability. What are the notes that are payable, short-term, long-term notes, and what are the terms of those? And so basically it goes in and provides some color, not in every area, but some color to some of the really key areas that are found in those other 3 sections of the financial statements. So if you're a school owner operator and you're relatively new to this and you're trying to figure out, what are some of the requirements? These are the basic requirements of a financial statement. The only thing really that ACCSC requires that wouldn't otherwise normally be required is that you have a line item for unearned tuition on your balance sheet to offset receivables for training that hasn't yet been delivered and therefore income or tuition revenue not yet earned. But other than that, it's a pretty basic financial statement that you would find in most any other company. And there may be some other nuances there, particularly if you're a school that participates in federal financial aid. Obviously, there are going to be some other nuances, but largely prepared in accordance with GAAP is going to capture most of it. It doesn't have to be an independent CPA. It can't be your brother's uncle, and so need to be able to demonstrate the independence of that individual, so the commission can rely on those financial statements. Okay, now what's new? So this year, in order to be able to streamline our review process, we have an accounting staff here, which means we have one person, Nikisha, that basically goes through and calculates an Altman Z-score and a composite score, or takes the calculated composite score out of every single financial statement for each one of our accredited institutions. In order to streamline that process, we've included now a financial analysis worksheet that will give us essentially the metrics that we would otherwise be plugging into these spreadsheets on our own. So essentially, if you can think of it this way, the difference between one person doing it 570 times and 570 people doing it once. That is the calculus that we tried to use in making the determination about this. So what is a z-score? Well, a z-score is a set of ratios and a mathematical calculation to predict the probability whether a school might go, a company might go bankruptcy within a period of time, 2 years. And so it's going to look at a number of financial ratios, and this is the z-score calculation. So liquidity, profitability, leverage, solvency, and activity. Those are all set of variables. You have multipliers, you add them all up, and you get a score. And within that score, it's going to be, what range to come up with the different aspects. So the variables are working capital divided by total assets or retained earnings. You can see them here. I'm not going to go through and repeat them all, but essentially, this is again all laid out on the worksheet as well, but just to give you a little more color to it, these are the different variables. And then as is laid out on the worksheet, you'll see that if it fits within a particular range, then there's not an issue relative or related to the potential or predictability of bankruptcy. So that is one section of the financial analysis worksheet where you would be putting in essentially these figures that are available straight from the set of financial statements that were prepared in accordance with GAAP. So all of these are known terms and known values that you're not calculating outside of the financial statement. They already exist. They've already been done. They're part of the financial statement preparation process. We're simply putting them into some ratios. The second area of the financial analysis worksheet is the composite score. Now, if you're a school that has been participating in federal financial aid, you know the composite score well, I would imagine. It's something that either department calculates or requires institutions to calculate. I think it's really the latter. And so that is part of the financial aid audit or part of what your auditor is required to do annually in order to demonstrate continued eligibility to participate in the federal financial aid Title IV programs. That score, again, laid out on this financial statement and financial analysis worksheet, has the calculation. The composite score sets up these ranges, and if you plug in the numbers and the values, then you're going to see that if you have a composite score that's between 1.5 and 3, you're in the passing zone. If you're 1 to 1.4, you're kind of in the area that was requiring some oversight, more likely than not, some form of heightened cash monitoring. Might be a letter of credit, might be provisional certification, something along those lines. Don't know all the ranges that the department has. Certainly, a letter of credit might be one of those. And then falling below is considered to be failing and requires some kind of action. Again, the department would again be looking to do something, or again, require some kind of provisional certification, heightened cash monitoring 2, which is a reimbursement method of repayment. Something along those lines would be the areas. Obviously, if you have questions about what these ranges mean, don't take anything that I've said here to be absolutely accurate. You should certainly check with the U.S. Department of Education to make sure that you understand what the actions are that go with each one of these zones, particularly if you fall within it. But all that is available through the department's website and information that they have available as resources. So why does it matter that ACCSC wants to use the composite score? Well, many years ago, when we were trying to figure out what might be one of the ways to determine for ourselves what might require additional monitoring, we were looking at things like z-score analysis. We were looking at things like the composite score. And essentially, the commission determined at that time, look, the department already has this score. They've already got a tripwire established at 1.5. ACCSC will also use a composite score tripwire of 1.5 as when it might go into some kind of additional monitoring. So that's why every year we are looking at the composite score, because in order to reduce redundancy, we're using the composite score the way that the department does to establish whether or not an institution might need some additional monitoring. And so that's why it's important that we get that each year with those financial statements, and that we can do it timely so that our staff here isn't recalculating something that's already been done by your accountant or has been already done for the Department of Education. Again, why the importance of the financial analysis worksheet is really helping us to streamline that process and that review. So ACCSC also has some differences in the way that it views this. So there's what we call heightened monitoring, not heightened cash monitoring, but just kind of a heightened monitoring. It might just be, hey, we're gonna keep a close eye on your financials. We've moved you to the top of the list for next year. You're in this range where you're falling into some additional review. Or there's also where the commission might look at the financial statements and say, we're far more concerned than just monitoring, and so we're going to put you on financial reporting. And I'll talk about some of those differences here in just a moment. But in either case, typically the way that this is handled is the first kind of layer is a staff layer of doing those calculations and looking at the composite score and seeing where the tripwires might be met through either the z-score or through the composite score. And then for those that do fall into that area of review, then we have a financial review committee. And you can see there that volunteers always needed. So if you're an individual that loves to look at financial analysis, financial statements, and otherwise could help us to review some of those things, that might be some area that you would want to consider volunteering. You can reach out to our staff, Michelle Ragland or Maria Sorokas would be available resources to be adding on for that if you wanted to think about doing that. So the Financial Review Committee reviews applications for accreditation. So every initial applicant that comes through has their financials reviewed, because those schools have to meet some initial tests before they can even begin the accreditation process. For every school going through renewal of accreditation, that financial statement will be reviewed by the Financial Review Committee in conjunction with the onset evaluation report. The teams would have had information along those lines as well, and information from the Financial Review Committee, so that when they go into the onset evaluation, they know whether or not there are issues with the financials. The commission would then have an opportunity to review that same information from the Financial Review Committee and any concerns, issues that they may have spotted through the review of that institution's financial statements. From that, when the commission is taking its actions relative to any application for accreditation, and this is also could be done in an interim monitoring, where it moves from monitoring to reporting as well. But this is where essentially, if there are significant concerns, an institution placed on financial reporting is going to be asked to submit a financial improvement plan. And within that plan, usually there is an MD&A, or what's called a management discussion and analysis. And this should be detailed. This should be cogent. It should be compelling. It should not just be, we hope to get more students, or we're going to add a whole bunch of programs that we have no experience in offering, but these are the wave of the future, and this will surely put us on the path to financial soundness. What the commission is looking for in this management discussion and analysis is thoughtfulness. Is, given whatever it is that is serving as an anchor, or that's serving as debt, or that's really impeding the financial soundness of the institution, what is the institution's realistic plan to overcome that, to correct it, and to improve upon it? Now, also a key element to this is a budget to actual analysis. And what the commission's looking for here is, there is a standard that talks about the school engages in, appropriate budgeting. But in order to really look at the projections that are in those budgets and see whether or not they are realistic and how close, particularly on the more often than not on the income side of things, how close the actual revenues are compared to what was budgeted. And therefore, is the institution keeping on track with the budget projections? And there are often times that schools will respond and say, we plan to have 30% growth over this next year, but it's just not realistic. And so if you are finding yourself in this kind of situation, remember that you want to be able to demonstrate what the plan for improvement is, without coming up with unrealistic projections and unrealistic goals that would be very, very difficult for the institution to meet. So we've got monitoring, we've got reporting. It's all reviewed by a financial review committee. It's all reviewed by on-site evaluation teams to see whether or not poor financials are contributing to also poor performance on the education side, lack of resources, things of that nature, and then everything also reviewed by the commission. Okay, so now that's item number one that's new. Also that is new is the fiscal year changes that are impacting a number of institutions. And because, again, these are driven by federal financial aid and the Department of Education, I am not the oracle here on those things. Certainly if you have questions about the department's expectations, you should contact the department. This is what we have gleaned and what we've been able to see and study and review. And as we understand it, in 2004, the department required institutions to align their fiscal year to their tax year. What that meant for most is impacting fiscal years 2025 and later. And so we are now starting to see institutions making a decision to or having to change their fiscal year to be to align with their tax year. So for most institutions, the tax year is January 1 to December 31. If you have a fiscal year, however, of July 1 to June 30, the department is asking those institutions to align and to change that fiscal year to be the same as its tax year. So what that means is that practically is that you may end up with a partial period that doesn't fit into this new area, this new fiscal year. And so again, if the change is from a July 1 to June 30 fiscal year to a January 1 to December 31, the company, the school is going to have a period of July 1 to December 31 in that first year of the change. That's not really picked up by either the previous financial statement or the new financial statement, because the financial statement is always going to be for just that 12-month period. So what that creates is this partial period. And if you were to audit that, it's something that kind of colloquially is referred to as a stub audit. It's partial year audit. And so that is something that we want to go and talk about as well, and the implications for that. So for ACCSC, what that means, this impacts what we think, based upon what we know about fiscal year ends, this impacts about 160 schools. That may change. We're assuming that the bulk of those do participate in federal financial aid, and maybe in this area. Now, it's our understanding, as from what we've read and what we've learned from the department, although again, this is Disclaimer, I can't say this is 100% accurate, but as we understand it, the stub audits are not being required in all cases, these partial fiscal year periods. In those cases, ACCSC is also not going to ask for a stub audit or an audit for a partial fiscal year or partial period that's no longer in a established fiscal year because of the change. But if the department asks for one, we're gonna ask for that same thing as well, just under the assumption that A, it's been done, and B, the department maybe had a reason to request it. But ACCSC is not requiring stub audits for these purposes. Now, where it is complicated for ACCSC, however, is that sustaining fees are aligned with the submission of fiscal year and financial statements. And so if an institution changes its fiscal year end, then that will have an impact on when its sustaining fees are due. And so I'm going to run through an example to kind of show practically what this means. But I think the bottom line for institutions is that if you're one of those schools that does have to make a change, then you could be in a situation where you will be paying multiple payments in one calendar year. And so I'm going to show you a graphic that will kind of explain all this. It has taken me months and months to get this through my own brain, so I suspect that there will be some confusion. I've tried to make this as simplified as I can. When you do make that change to your fiscal year end, you're going to submit a payment using the prior full fiscal year. So let me show you how that works out. Okay, so let's say you're a school that originally had a fiscal year in June 30th. In this case, we're going to say your fiscal year end came to be June 30, 2025. That means that your financials and sustaining fees were due 12/31/2025 because financials are always due and sustaining fees are due 180 days or 6 months after the end of your fiscal year. That payment that was made for those financials on 12/31, well, that pays for fiscal year 2026 for ACCSC. That's your sustaining fee for fiscal year 2026. And the reason for that, if you look at the box in the bottom, these due dates are either for the upcoming or for the current fiscal year. Now I'm an institution. Now I've got a new fiscal year end of 12/31. I've changed it. My tax year ends at the end of the year. I need to go through and still pay my sustaining fees for 2027. So that means that even though you just paid 12/31/2025 for ACCSC's fiscal year 2026, you're going to pay again June 30th, 2026, and that's going to pay for fiscal year 2027. Again, due dates July 1 to December 31 pays for current fiscal year. Due dates January 1 through June 30 pays for the upcoming or next fiscal year. So your 12/31/2025 paid for 2026. Your 6/30/26 is going to pay for 2027. Now, note here as well, you're going to use the same financial statements. You're going to use that 2025 financial statement in order to be able to make that cash. So basically, you'll be paying the same amount twice. If there is a significant difference between those, when we get the next set of financials, we may adjust that, but for the most part, we're just going to work off of the 2025 statements for now. Not really sure what that impact may or may not be. So don't hold me to anything at this point in time, but we just want to keep schools on the path to paying for the fiscal year that they need to pay for. You can see that there's going to be an 18-month gap between the last set of financials that we got and the next set. So between 12/31/2025 and June 30th of 2027, again, those financials for your new fiscal year end of 12/31 is going to be 18 months. So in order to not wait 18 months for payment and missing an entire fiscal year of sustaining fees, those schools will have to pay twice within a 6-month period of time. that payment that's made June 30th of 2027, well, that's going to pay for fiscal year 2028. And then there forward, you're going to be on your regular cycle after that. And so that will pay for each fiscal year for ACC ongoing. This is just one example. There could be several others if you've got a fiscal year end of March 30th or September 30 or whatever, March 31st or September 30th. Obviously there are many permutations of this. This is just an example. Now, I'm really happy that there are folks that are attending this and that are hearing this and can be prepared for that, because we are going to send out a reminder and an alert to the same degree to say, hey, if you're changing your fiscal year, number one, you should tell us. That would be really useful information so we can update our records. Many institutions have not told us this information, and we're surprised to hear that it would be useful information for us to know, because we do track all the fiscal year ends, so we know when financials should be submitted. So it'd be really helpful if you would let us know that that change is happening. On top of that, we're going to be reminding and alerting institutions to this situation, this scenario about when institutions will need to be paying because of this kind of awkward interim step of having to pay twice within a less than 12-month period of time. It will likely impact most, if not all, schools that do end up changing their fiscal year end. We haven't checked every financial year end, but we've run it through several tests, and they all seem to require some kind of iteration of this between having to make one payment within 6 or 9 months or whatever the case might be. Now, if you're one of the schools like in this example and you miss making that payment 2027, the institutions are still required to pay timely. This alert that will go out will be, again, expressing that as an expectation. And so any lateness in submitting that will be required to submit also a late fee that the commission would otherwise normally require. So I hope that, well, first of all, I think I set a record for saying fiscal year end the most times in the history of all fiscal year ends. But I hope I didn't make this any more confusing. I hope this helps to clarify a little bit for those institutions. Now, if you're in an institution that you've never heard of this thing about changing fiscal years, this is the first time you've ever heard about this, then I encourage you to go and look at the requirements of the Department of Education if you're a school that participates in federal financial aid. And so Michelle says that I have some questions, and so I'm going to go ahead. I'm actually, you know what I'm going to do? I'm going to keep that previous one up because maybe people can continue. What do we got?
Okay, so Dr. Gillen asks, does this mean the financials no longer have to be audited as long as we have what's listed in this webinar? They must be audited.
No, they need to be absolutely always prepared in the exact same way. The only thing that this webinar has talked about is that if you're changing your fiscal year end, it's purely a date change, nothing else regarding the submission or preparation of the financial statements, the use of the submission of the new financial analysis worksheet. None of that changes. And if I in any way set that as an expectation, then I apologize. That in no way is what's happening here. This is simply, if the school changes its fiscal year end, here's how you got to pay your dues. Other than that, everything else stays the same. What else you got, Michelle?
So Donna asks, for the purpose of the information input screen, do you consider a deferred tax asset an intangible asset?
I'm going to defer on that question because that sounds like an accountant asked that question. I'm gonna send you those kinds of questions. I can't answer those on this webinar. And so I'm going to ask you to reach out to Nikisha Nichols directly on our staff. She is likely listening to this webinar right now, and she can answer those kinds of questions. But the way that assets are calculated, again, we don't have specific rules around that. We're asking institutions and for accountants to use GAAP. Now, maybe there are different interpretations. Read through the instructions. If it doesn't mention the classification of assets or things along to that level of detail, what we're expecting again is that the accountants are using GAAP methodology.
Okay. And Stephen is asking, does the fiscal year end alignment with tax year rule apply for both nonprofit and for-profit institutions?
That is a question for the Department of Education. Again, I'm not trying to interpret what the department's rules are or to establish those or to be in any way an authority on what that is. If you have questions about what the department requires of institutions participating in federal financial aid, you should contact them directly. I'm simply trying to put forward that if you're a school that knows that you need to make a change and you're making that change, here's what the impact is for ACCSC.
Okay, and one more question. Matthew asks, we are a nonprofit and our annual audit is due to the Department of Education within 9 months of fiscal year end. Your first slide said audited financial statements are due within 6 months of fiscal year end. Does that mean we have to have the financial statements audited prior to the Department of Education audit?
Typically, for all of our institutions, we require 6 months. I do understand that the department may have an additional allowance for that, but we have always expected all financials to be done within the 6-month period of time, unless there's some other reason for the submission to be later. Sometimes it might be for a publicly owned institution that the locality that owns and does, the state of Ohio or whatever, might have some special dispensation for that. But other than that, ACCSC requires all corporations, for-profit, nonprofit, whatever the case might be, to be submitting their financial statements within 6 months. If you have further questions around that, I'm happy to again follow one-on-one with that one as well.
Let's see. And then really the biggest question is, will we keep a webinar recording and a copy of your presentation on the website?
We will keep a copy of this. This will be under the training resources section. So hopefully you'll be able to refer back to it if you need to. For newer schools, for schools that this is, you just kind of hand it off to your accountant. I do think it's important that you at least understand the basics. And so I do think having said that, I think it's important to read through the instructions for financial statements. That's on our website. So at least you may not understand all the terms. And I think that accounting speak can sometimes be intimidating. But if you just think about it, even just along the lines of kitchen table accounting, one of the things, again, as I said before, assets and liabilities, do they line up? Do you have more than you owe? And as a kind of operating a business, how can you interpret those financial statements to your benefit? So hopefully, yes, this presentation, this recording, I know that I haven't been able to answer all the really specific questions, and that has not been the intent of this. This is really just to give a very basic overview and primer, and to set up and talk about the new worksheet and this example on changes to fiscal year ends. Again, disclaimer, not an authority on all things federal financial aid. If you need to confirm anything with the department, you should contact the Department of Education directly. All we are working off of is announcements that have been made in the Federal Register, and what institutions have communicated to us are the changes that they are making and why they are making those changes. So we're simply coming out to talk about this in a way that we think helps to answer some questions for institutions before they get too far out of the way. So hopefully that's been useful information for some. We will certainly be here and available should you have specific questions. Again, Nikisha Nichols is our on-staff financial analyst and can answer any question that you have about the way that we look at financial statements and what we typically see and what those expectations are. I'm certainly available to speak with you as well. Alicia DiMartini, our Associate Executive Director, can also speak with you if you have questions about generally what the expectations are. And certainly, if you have questions about the payment of the sustaining fees, Elaine Casa is on our staff and works with institutions on our side of the accounting, invoicing, payments, and things of that nature. So we're all available. If you have any questions, we encourage you to reach out. With that, I want to thank you for your attendance. Thank you for the questions that you did have, and hopefully we've helped out a bit. But if you need more help, just don't hesitate to reach out. Thank you.